that you'd have working at your company. You might have a whole room full of people that do accounts payable and accounts receivable. That's typically where you start. When you get a job at a company doing accounting, you're going to be in a pool because most companies are sending out lots of bills, doing a lot of billing, and lots of money coming in that they're depositing. So they might have, and they could have a whole building. When downtown in Tulsa, those two big buildings were the Dollar Thrifty Rent-A-Car. They're not there anymore. The Dollar Thrifty Rent-A-Car, two towers there on Yale, I think it's Yale, and those were all accountants, two whole buildings full of accountants for Dollar Thrifty Rent-A-Car, which sold out to Hertz. All those people, a lot of them lost their jobs. But anyway, the point is you could have a whole room full of people doing accounts payable and accounts receivable. You might have some people that are doing fixed asset accounting. You're going to have people doing payroll accounting, right? If you got a great big company. Now, if you're a small company, you may be doing all that yourself, right? But there is a place, and as I said before with payroll last week, there is a place when you want to say, wait a minute, I can handle this, this, and this, but I need a professional for this. Now, when we start talking about bonds and stocks, these are at a whole different level. These are people that have master's degrees in finance and or most likely finance, and maybe they're CPAs, and maybe they're certified financial planners, and they got all of these acclimates behind their names, because these are getting into some real complicated things. And I know in my previous job, I was the chief financial officer for Tulsa County, and we issued lots of bonds, because anytime you're with the government, anytime that you have a vote to give money, and maybe those of you are old enough to know that when you vote, one of the ones that everybody's familiar with is school bonds, right? The schools are always trying to sell you, oh, we need a new gym, or we need a new track, or we need new buses, and we're going to sell bonds, right, to pay for them. Well, that means the people in the state of Oklahoma, anyway, for the government to issue bonds and borrow money, there's a certain amount, they have to go to a vote to raise taxes to pay for it. But the point I'm getting at is those people that work at the place, like the financial officer or the accountants, they're not going to be drawing up the bond documents. They hire attorneys to do this. Attorneys make lots of money, and these attorneys get paid huge amounts of money to draw up the legal documents of bond and stock issuing. The same way there's accountants, and typically the financial people that do the financial side of bonds and stocks are going to be, on the bond side, it's going to be Bank of Oklahoma has people that they call financial advisors, but really they're high-level accountants. They have to be able to project out into the future what kind of revenues we're going to collect over the next 5, 10, 15, 20 years. And as we know by the current events of our country and our world, I guess, you can never project everything that's going to happen, right? You can only try. So anyway, these are very highly specific jobs, bonds and stock issuing, and you probably would not necessarily have somebody in your company, unless you work for a bank or you work for a big brokerage firm like Goldman Sachs or one of these. They have people that do initial public offerings and things of that nature for stocks. Okay, so I know I said a whole lot about that, but don't get discouraged. I can tell you bonds is one of the areas that things start to get, and you say, well, it's all complicated. It really can be complicated. Okay, now this chapter kind of keeps things like you should be on a somewhat entry level, but it is challenging. So don't get discouraged, and that's why I'm going to go over it here a little bit. Two different methods. Now, the reason why I pulled up bonds and stocks here together is because I want you to think about you're a business and I need money. And when I say money, I need cash. Now, how do I get cash? Well, number one, I can do whatever I do to earn cash, right? If I'm Google, I sell advertising. If I'm Ford, I sell cars, right? But whatever it is that I'm doing to bring in cash through operations, but let's just say I don't have enough cash flow with operations, but I still have to pay my employees and I still have to pay the rent and all these other things. So I need cash. So the other thing I can do is I can sell things, right? If I'm hard up on cash, just like your own life, you know, if my revenue coming in, my paycheck's not enough to make my bills and I've got to make my bills, I either need more revenue, which means I need to sell more or whatever I'm doing, right? Or work more, 2 jobs. Or I can sell stuff. I can have a garage sale. I can put it on Facebook Marketplace or eBay or however it is that you sell, right? A business is the same way. If they're hurting, they're going to go through and they're going to look at their assets and they're saying, what can we sell? And one of my favorite industries, as you know, is one that's being hit extremely hard right now, and that's the cruise ship market. So all the cruise ships around the world are just pretty much shut down for 3 months. Like it started as 30 days, then it was 60 days. Now it's 100 days that the United States has said no cruise ships. So they're all sitting out there in the ocean, just sitting there. Now, most of them all got the people off of them, but there's lots of crew people. Imagine 100 ships sitting out in the ocean, and they each have 1,000 crew member. That's 100,000 people. And they have to pay those people. So they got a problem now, right? Because they don't have any revenue coming in. And so they need cash because they got to pay these people. They got to buy the fuel to put in those ships. Even if they're just sitting out there, they got to run generators and stuff, right? So they need cash. So now we've got, I could sell some stuff. And this is what I was going to say, is if I'm going to sell some things, I could sell old assets that I don't need anymore. Think about if you're a business and you have, like I said, even if I'm the lawnmower guy, right? I got my 0 turn, but I got an old one in the garage, right? I can turn around and try to sell it to get cash. If you're Carnival Cruise Lines, don't be surprised if you see them trying to sell off some of their older ships to other smaller cruise lines because they're trying to generate cash. Okay, so we get more revenue. We sell stuff that we got laying around, and the third one is we could borrow money. Okay, and we borrow money by one of 2 ways. We can go to the bank and say, "Give me a loan." And if you were Carnival right now, and pretend like you're a small business, but you're Carnival, and you go to the bank and you say, "I need to borrow, $100,000 to get me through the next 3 months." And they say, "Well, how much revenue do you have coming in?" And you say 0. And then they show you the front door, right? So you're out. You get no money because you have no revenue coming in. And the bank wants to know that you have enough to pay the bill, the interest. So the bank doesn't work. We can't borrow money through the bank. But now we have 2 other options here, and that's why all this whole discussion is to give you an overall understanding of what this is all about. And you will revisit this in your finance class because this is really, stocks and bonds is really an area of the finance program as opposed to more accounting. Accounting is how do you account for it, but finance is how do you do this and why do you do this? Okay, so we have 2 options. If you'll notice here, bonds brings cash into the corporation. Stocks brings cash into the corporation. So I'm a corporation and I need money. The bank won't loan me any money because my revenue is not good enough. I don't have any old assets to turn around and sell. And I don't have any revenue because the government shut me down for 3 months. Now I got an issue, right? I got to go out and borrow money. Now I have, as a big corporation, I have maybe hundreds of thousands, if not millions of shares of stock that they call treasury stock that the company holds. I hold these stock. Now I could go out and sell the stock on the market. Now the problem with that is right now the cruise ship stocks have tanked. I think Carnival is around $11 and that just bounced up. And I'll tell you about that here in just a second why. But Royal Caribbean is dropped more than 3/4. Carnival's dropped 3/4. I think Royal Caribbean was over 100. Now it's something like 40. So they've dropped substantially. So for me to go out and try to get cash by selling stock on the open market is foolish, because when do I, as a business, when do I want to sell my stock? When it's high, right? That's really when you want to issue stock, right? Unless, of course, you're just starting out and you're doing an initial public offering. But we're talking about I need money right now. So my last option is I could do a bond, and a bond, if you know anything about bond, is it's a loan, right? I'm borrowing money, and you say, well, what's the difference about if going to the bank and saying, please, Mr. Banker, give me some money, or issuing a bond? Well, a bond is an instrument that's based upon the integrity of the company. It's a financial instrument, and I am going to sell it, and I'm going to sell it on the market, on an open market, just like I would sell stocks on the market. Okay, so when you have an initial public offering and you go to Goldman Sachs and you say, I'm going to sell my stock and to people to get money, I would go to another type of brokerage firm, but very similar to that, where I'm going to sell bonds in my company. Okay, and so it's basically a debt that I'm trying to sell to raise money. It's different from a loan because it's not like the bank is financing it, right? It's people like me and you who buy bonds. And maybe if you know anything about investing, you know, they always talk about balanced portfolio. Buy stocks and have some bonds, right? Because they kind of go different. Like, in fact, this is a good example when we were just talking about Carnival and these stocks. The bonds, they're paying really high interest rates now because and what I was going to tell with Carnival, Carnival just borrowed $7 billion. I think it was seven. No, I think it was, they had $3 billion in cash and they borrowed $4 billion, and they borrowed it from the Saudi government, the Saudi sheiks or something. I don't know. Anyway, they got some money. Maybe those people will, I don't know, they're like the $1 billion loan sharks or something. Anyway, they're paying high interest rates, right? Because they're volatile. But maybe you're a strong company. Maybe think about American Airlines. Well, we're going bankrupt and we filed bankruptcy, but we need cash to help us bring us out of bankruptcy. And, you know, we've been around for 100 years, and if we can pull ourselves out of bankruptcy, then possibly we'll be around for another 100. So this is where an investor might say, well, I'm going to loan money to Carnival, or I'm going to loan money to American Airlines or Ford or AEP or the government, right? In fact, on the government, there's a website you can go on that you can pull up every government bond that's out there, because of course it's all regulated by the government. But you could pull up Tulsa Public Schools or Wausau Public Schools or Rogers, county government, or the water district. Any government entity that issues bonds, you can go out and buy them as an investor, right? And basically what you're doing is you're buying and trading bonds just like you would buy and trade stocks. To the company, I have an issue. I need $1 million. In the case of Carnival, I need $4 billion. And I'm going to go out and sell these bonds to whoever's going to invest in them. Okay? So this is kind of a rundown between chapters 11 and 12 to get our minds around what this is all about. The bottom line is, number one, we're a company and we want cash for whatever reason. Maybe we're doing really good and we just need cash to expand. You know, maybe we're doing great and we want to open up more restaurants, or we want to open up another gigantic Amazon warehouse so we can do 1-day delivery instead of 2. So we might be doing great and we still want cash, and we can still use these two methods. Okay, now bond is a debt, just like we owe the bank money. A stock is an equity. So when you say, I think I told you when we first talked, maybe chapter 1, I don't know, we talked briefly about corporations. If I own 1 share of Walmart, I am an owner of Walmart. If I own 1 share of Amazon or Apple or Microsoft, I am an owner of that company. And so you'll see here under stocks, equity to the corporation, the stockholders are owners. And if you have 1 share of stock, you're an owner. Now the bondholders are creditors, just like when I borrow money from the bank. Only I don't owe the bank money, although the banks normally do the funding. You know, I say you don't owe the bank, but the banks do act as an intermediary. right? Because they want to get their cut. They get a big percentage too. Okay, so interest rates must be paid. So because I'm borrowing money, I have to pay interest. And interest is the cost of buying money, basically. Dividends are not a liability. They are paid only if the board of directors declare them. So if I'm a shareholder in a company and I own stock, the only way I get money out of that company is if they decide that they want to cut us in on the deal, right? If they want to declare a dividend and pay us some money back. So and I'm not talking about I'm going to buy the stock and I'm going to resell the stock. That's an investment. But if I want to be an owner of Amazon and they're going to pay me any money that they're making, it's going to come out as a dividend. Now, the interesting thing about this is interest has to be paid, and dividends do not have to be paid only when the company decides to. Bondholders get paid interest and principal, but no more. They don't get any more. They're entitled by contract. A bond is a contract, which there's a specific name for it. We'll see here in a minute. By contract, you're going to get 10% interest. I'm going to borrow $4 billion and I'm going to pay you 10%. In fact, I think they're paying around 7%, which is really high for a big company like, Carnival. Anyway, if the corporation is very successful, owners may get paid a lot of dividends, no upper limit. The board of directors could say this year we're not paying out 10%, we're paying out 25%, right? So it's whatever they've decided to do. There's no upper limit. Now, unfortunately, well, I think there's another number that talks about that. You also have more risk, right? No voting rights because you're just a debtor. Over here, you can vote because you're an owner of the company. Interest is tax deductible to the company. If the company borrows money, just like I hate to even say this, you can borrow. If you buy on your mortgage payment that you pay, the interest is deductible if you itemize deductions. But to a big company, if I'm paying interest to Bank of Oklahoma or I'm paying interest to a bondholders, that money is an expense to me as a company, so it's tax deductible. That lowers my tax liability. Remember last time I talked about the bottom line is what do you put in your pocket, right, at the end of the day? And even if you're a big company, the bottom line is how much money are you really making, cash in the bank. So dividends are not tax deductible. So they're not an expense, and that's another thing I think we'll get to when we get to, well, how shall I say this? We talked a little bit about dividends. They're an expense on our income statement, but they're not a cash payout, right? Bondholders have first claim in bankruptcy. If the company goes bankrupt and they can't pay right into this stuff, and you're like, well, how does this all fit together? I mean, I understand payroll because everybody gets a paycheck if you work somewhere. And I can understand fixed asset because if you have a business, you have assets. But then when you start talking about bonds and finance and stocks, then you think, well, who does this and how does this fit in, right? The bottom line is it's typically about generating cash. And like I said, bonds, many times we have cash that we want for a specific purpose. Okay, so now we're going to talk a little bit about terminology. So objective terminology and accounting for bonds payable, which is actually not as complicated as maybe some of the things you've seen unless you get in. Now this chapter doesn't get all the way into the full-blown deal, which is really good because it can get complicated in a hurry. But describe and illustrate the reporting of bonds payable. Okay, so that's what you typically do. So a bond is interest. An interest-bearing note. So in the last chapter we didn't talk about it, but a note is a loan that I'm going to pay off within a year. Like I borrow money from somebody and I say, I'm going to give you, I owe you, and I'm going to pay interest on what you borrow me. So borrow to me. Okay. Like a note, a bond requires interest with the face amount to be repaid at the maturity date. So now the reason why bonds can get complicated is because when we start thinking about going to the bank, most of us, if you bought a car or you bought a house or something that you borrowed money for, you can kind of understand the way that works. But bonds are a little bit more tricky because remember they're I hate to say physical because they're really not. It's a big book of papers. It's a legal document. And I'm going to say I'm going to sell this, right? I have a, it's not really a physical asset, but you know what I mean. It's a instrument that I'm going to sell. Okay. Now, just like anything, in fact, let me get to this. Yeah, here. Just like anything, I'm going to go back to the slides in a second, but here's what we need to know. The face book of the bond, the interest rate on the bond, and the market rate. Now, there's different words for this, but face book is how much are we borrowing, basically. How much money do we need? Well, I need $1 billion if I'm Carnival, or I need 100,000 if I'm a small business, right? Typically, small businesses are not going to be issuing bonds. This would be more corporate, bigger businesses. But nevertheless, okay. So face is just really the amount of money I need. The interest rate is the amount of interest that we're going to say we're going to try to get. Now that's where that bank finance people try to sell you, just like they try to sell you a mortgage at a certain rate, or you buy a car at a certain rate, right? The bond people are Standard & Poor's, which you've probably heard of, and they're the ones that are kind of like the credit agency of bonds. And really it's because they're analyzing the business. Like we all have a credit score, and they look at you and say, hey, can Tom pay back this debt? He wants to buy this new car. Can he afford to pay for it? Well, the S&P people, the Standard & Poor's, they're looking at, can this company pay it back? So you get a bond rating. If you're an investor in a bond, you'll see that there's ABC bonds, AAA bonds, B bonds, C bonds. A bonds are the best, C bonds are the worst. If it's a C, and again, it has to do with risk. If you have a C bond, then you can get more interest. Like Carnival right now is, I don't know what their bonds are rated at, but they're probably pretty low because they have no income. Okay, interest rate on the bonds, the market rate. So think about what we're talking about. Now, maybe, I don't know how Carnival did it, but you know, they probably went to some Saudi prince and said, hey, could you pull out $4 billion out of your back pocket? And he said, sure. But in most cases, it doesn't work that way. If you're American Airlines or Ford or Chevron or any of the oil companies now, they're all hurting now, supposedly, although I don't have any sympathy for them. But they're going to issue bonds. They have all these finance people, all of these attorneys, drawing up paperwork, people voting on boards and all this stuff. So when we draw up this big book, it looks like a big book. I wish I could show you a picture of one, but it's like a big, I hate to say it, I mean, it's like one of those big family Bibles that people used to sit on their coffee table that was giant. That's what it looks like. It's a big, gigantic book. It's papers, and it's all done that way so the attorneys can make money. At least that's my opinion. But anyway, so it takes time. So if today's, and if you, especially like right now in the world we live in, but under even normal circumstances, interest rates fluctuate all the time. So think about the stock market. The stock in a company is fluctuating by the minute, hour by hour. It changes by the day. It changes, right? Well, the same is true with the bonds, because they're an instrument that I'm going to sell. And like anything that I'm going to sell, whether that's my old car or my brand new car or a block of gold, what it's worth fluctuates. So what it could be worth right now and what it's worth a week from now could be two different things. So if if the bank sets my interest rate and where I'm going with this is, this helps you understand when you get to all the accounting part. What happens is I've said, or the bank and the person issuing the bond agree, and we're going to issue this bond, and we're going to be willing to pay, say, 10%. We're going to pay 10%, and the bank says, good, we're happy you're going to pay 10% because that's really high, and we can sell those bonds real easy, right? That means somebody's going to buy that bond, and we're going to pay them 10%. Which is a good investment right now, right? Better than money in the bank. Okay, interest rate on the bonds. So where I'm going with that is if we say today, and we all got together and we're attorneys and bankers and accountants, and we say, okay, we're going to set it at 10%. It's going to be a 5-year bond for $1 million. Okay, now that's all based upon the company and the rating and all that, just like with us with our credit scores. But then a week from now, we get the COVID-19 virus, or maybe a week from now, the unemployment records go way down and the economy changes. And now my thing that says 10% on the front of my big old book is no longer valid, right? Either my value of my bond, like Carnival, just tanked and it's like, oh my gosh, nobody's going to even loan me money unless I give them more than 10%, right? Or maybe it's the opposite. Now, all of a sudden, hey, we came out with the coronavirus vaccine, and now we can issue bonds. Our bonds were written at 10%, but hey, we're gonna want to get a discount. We're gonna only want to have to pay 5% now because we've got this new thing come out, this new drug, right? So they fluctuate, and that's what this is about. The face amount is what's written in the documents. Say that's 10%. In fact, 12 is what I use here in my example here in a second. I'm sorry. The face amount is the dollar amount. That's like the $100,000 or $1 million, whatever I need. The interest rate is whatever's on those documents, 10%, 12%, whatever. The market rate is what the people are willing to pay. And just like stocks, it changes on a daily basis. Okay, so that's why this is important here. Now let me go back real quick. I know we're only on slide 3. Okay, periodic instrument. Okay, bonds pay semi-annually. Most bonds, now they don't have to. I don't know that there's any law that says this. But what that means is when you make a payment on your car or your house or pretty much your credit card, anything you borrow money for, every time you make a payment, you're paying principal and interest, principal and interest, principal and interest in every payment. In your school loans, you're paying principal, although now they've suspended that. But on a bond, typically what happens is you pay interest semi-annually, twice a year, every 6 months, and then you may pay principal once a year, or in some of these bonds like they talk about in your book here, you don't even pay it back clear to the very end. In other words, you're going to give me $10 million and I'm going to pay you $10 million back in 5 years. But every year, I'm going to be paying the interest on $5 million. So think about the bank loan. The bank loan is the principal goes down every month. So the interest goes down every month, right? Because this year, I don't know if you've studied all this, but you got a loan for $10,000 to buy a car, and you make one payment of $200. Now you only owe $9,800 or something, right? It goes down. So then the interest is on $9,800, not on $10,000. But on a bond, I'm paying that back at the very end. So I'm not paying you the $1 million until 5 years from now. So every payment is based upon the $10 million. And at least that's the way they're showing it here. Now, it doesn't always have to be that way. We paid principal and interest on our bonds, and we would pay semi-annual interest, which means every 6 months you pay an interest payment, and we paid an annual premium. So in other words, if we were going to pay $10 million over 10 years, every year we'd make $1 million payment, and we'd pay the interest every 6 months. Okay. And these are a lot of, this here word, bond indenture, I don't know how much you need to know that. I don't know if that's in your homework or not. That's what it's called. When I said the big fat book and all the legal stuff that's in there, that's called a bond indenture. That's another thing that makes this complicated, is they've got all their own terminology. I had to learn all this because I didn't know anything about this when I got into government accounting. So you've got convertible bonds, you've got callable bonds. Basically these are all fancy words. Think a callable is where they come up with these words, I don't know. But in other words, if I have a loan on my car, like a lot of people do, and I'm paying 8% interest, and I'm driving by the credit union and they say car loans 3%. I'm thinking, heck, I'm going to go and see if I can get that, right? And what do? I go into the credit union and say, oh yeah, you qualify for the 3%, and I pay off my 8%. right? That means I've gotten rid of the 8% loan and now I got the 3% loan, right? I use the 3% to pay the 8% people. And that's what callable is. Callable just means if I decide I'm the company that's issued the bond and you've bought it at 12%, and now all of a sudden, hey, I can get interest rates at 5% because we did come out with that, new drug or whatever. So I can get 5% now loans instead of 12. Then I can call those bonds, which means I'm paying you off. There's some that are not. Convertible means that I can convert it to stock. If I'm the person issuing it, and I say, well, if you can't pay me cash, pay me stock. I want equity in the company instead of money. And that's convertible. And again, real complicated. So we talked about these three things that you need to know. Coupon rate, again, lots of words. Interest to be paid is the contract rate or coupon rate. We call that interest. This is the interest that's in the book, right? They call it coupon, or in your book, coupon is typically what they call it in the finance world. Contract, they call it, because that's what's in the legal documents. That's the coupon rate. That's what's written down. That's my 12% that I've agreed to borrow money at. The market rate is whatever that is worth, sometimes called interest rate. The market rate is affected by various factors, including investors' expectations of current and future economic conditions. Okay, that means if I'm investing in bonds and there's a million, if I could choose between, I can buy Broken Arrow or Jinx or Owasso or Tulsa, or Sand Springs. They all issue city bonds. And I say, well, if I buy Owasso bonds, they're paying 5%, but I can buy Broken Arrow and they're paying 6%, then I'm going to buy Broken Arrow, if all things being equal, right? So as an investor, just like buying stocks, you have preferences based upon a lot of things, right? Maybe you think that it's safer to invest in Owasso than it is Broken Arrow, and so you think, well, I can accept. Now I'm using cities because that's what I'm used to, but it could be companies. Maybe I think that Ford has got a better chance of making money than General Motors. So if Ford is paying 5% and General Motors is paying 6%, I'll stick with Ford because I think they've got a better chance of paying me back, right? So, but my indenture, this coupon rate says 10% or whatever it is, and the market is whatever the market says. Okay, so I know it's a long time on this. Okay, so here's the situation. By the time we put these paperwork together to sell these bonds, I say sell them because we're the company, we're selling this instrument to get money. It can sell for more. Oh, well, first of all, it could sell for equal. In other words, if it says 10% and everything, the market says 10%, that's sell for the same. My coupon rate and my contract rate are the same. My market rate, and my coupon rate are the same. Now, it could sell for more. In other words, just like if I'm Carnival and I was issuing a bond and I was going to pay 10%, and then the whole world crashes and now I can't even get anybody to buy my bond, then I'm going to have to pay more than 10%. Well, what if I pay 15%? Well, what if I pay 20%? Right? But the paperwork says 10, right? But I need to give people more money to be able to attract them to buy my bonds, and that's what this is going to be all about, right? It could be less. Maybe we're the company that came up with the vaccine, right? I was paying 12% interest, but now I got the vaccine, and so I only should have to pay 5% because I'm going to make tons of money next year, right? So now I'm saying no. I want more money. I want more cash, or I want to get a less interest rate. Basically, is what it is. All right. So I got this little diagram. This is out of your book, but I put a little thing in here. So this is what you want to use, and I got some things to help you, because this is what you're going to do. You're going to have to do the accounting in your homework for this, of course. Market rate 13. Now, first of all, in the middle is equal. My contract rate, which is in my book, my indenture, says 12%, but the investors, when it says market, it's the same as like stock market. the market says we'll pay 12%, they're the same, then we're good. It says it's sold at face value. In other words, my $1 million at 12% is what I'm going to pay for the next 10 years. Okay? Now, if the market is more than, and this is where it gets confusing. In fact, I should probably tell it a premium over here first. The market rate is less, but my contract is more. Okay? The market is going to pay less, then they're going to have to pay me a premium. In other words, they're going to have to bring up the money. It's sold at a premium. In other words, I'll have to show you here an example because it's hard to describe it. This is a discount. So I'm either going to sell it as a premium or a discount. And this is why these words are confusing, because you got to kind of almost look at a chart to understand what they're saying. If, in fact, let's look at the numbers. The face amount of the bonds is less than the selling price. It's called the discount. The selling price of the bonds, okay. The face amount is less than the selling price. It's called the discount, and that's what this is, right? It's either a discount or premium. So here's the deal. I tried to write this. I know it's scribbly. The market is, say the market is 13% and my contract, my paper, is 12. Well, we need, before anybody will buy my bond, meaning they can go out, if I'm Ford and General Motors is paying 13 and I'm Ford and mine's written up at 12, if I want anybody to buy my bond, I have to pay them 13 to get them to buy it. Right? I have to sell it at a discount. And what that means is, when you say a discount, my paperwork says 100,000 because that's what my face value was. But when I get my cash in my hand, I'm only getting 96,000. Now these are rough numbers just to make an example, right? In other words, I've discounted my $100,000 because you want an extra percent, the market. So I have a 12% note on 96,000 instead of 12% of 100,000, right? So that's a discount. The other one is the premium. The contract is 13%, but the market's at 12, right? We get a premium to give the market only 12% by them giving us more money up front. So we're going to get 103,000 from the market, not the 100,000. Okay, so that means premium means we get more money. Discount means we get less money. That's the best way I can say it, right? The ones issuing it. Now, on the other side, the reason it's confusing is because the buyer is the market. The market, what are they going to get, right? Are they going to have to get more or less interest than the 12? That's really what it is, right? Because I'm buying your instrument and you're paying me the 12% to take your instrument. Now, do you have to pay me more or do you have to pay me less to keep me to buy your bond as opposed to somebody else's? Okay? And that's just the same way that the stock market really kind of works. But this is all legal and it's all written. And that's why it's written in the paperwork that this is the coupon rate, right? Okay. And let's continue here because we're already at 6:30. Almost. So then it's going to go through all the accounting. Now, so I don't keep you forever. You can go through these and you'll see, well, here's where it's the same. So they're going to go through all three scenarios. So remember, those of you who are having a hard time following this, there's three different scenarios. They equal. Market and contract is equal. That's good. Makes it easy. The market and the contract is different, and the market is greater than the contract, or the market is less than, right? And that determines whether it's a premium or a discount. So three different scenarios. So I'm telling you that because once you get to these where they're talking about bonds issued at face amount, that means the face amount's 100,000 at 12% for 5 years, and the market is 12%. right? It's equal. So that's the easiest one, obviously, to do. You get your $100,000. So think about this. This is, remember, debit, cash coming into my business. Debit is cash going up. So I just borrowed from the investors, the market, $100,000, and I get $100,000 in my bank account. Now I can take it to build my gymnasium or whatever I'm doing with it, right? That's all in those documents. Those legal documents typically even say this money is for this, especially in the government or nonprofits. All of your hospitals, another ones that issue lots of bonds is St. Francis and St. John's, Hillcrest. All of those issue big bonds. And typically, because those are a lot of times the water and electric, AEP, PSO, all of those companies issue bonds when they want to do debt. Because when you're in those agencies, you're not borrowing, 50 or 100,000. You're buying 50 million. The last bond I did at Tulsa County before I left was $57 million. And guess who pays for that? Yes, the taxpayer. And it's sales tax. So don't say, oh, I don't live in Tulsa County, so I don't have to pay it. Huh? Do you shop there? Do you work there? Do you go to Quick Trip there? Anybody that shops. Now, I could talk all night about that. Don't get me going. If you live in Rogers County, you're paying for lawsuits.
Can you take a few minutes to explain the amortization?
Okay, so the amortization is just the payback schedule. Okay, so
Okay.
let me show you this. In fact, I want to show you before we leave, I want to show you this spreadsheet.
When at the bank you are paying the interest with the principal?
Except for that the bond is typically not paying principal annually. They could pay it annually, but a lot of times in your book, they show that they only pay it at the very end. Okay. So in other words, you're just paying interest payments. And that's another reason why it's very attractive, because governments I could borrow $50 million and for 10 years, and I only am paying interest. Wouldn't that be great? And then you know what happens at the end of the 10 years? They go and they issue another bond to pay the old bond. So it never goes away. We just keep paying the taxes. Cash money. This is when they're the same. Remember now, this case scenario is they're equal. Market and contract equal. I get 100,000 and I owe 100,000. And I pay back my interest. In this case, it's $6,000 twice a year. It's 12%. So 12 divided by 2, 6% every 6 months. And then at the end, this is at the end of the 5 years. See, it says year 1 and year 5. At the end of 5 years, I pay back $100,000 cash. Right? Very simple. Now, discount. Now this one, and you'll see this as you go through it. Face amount 100,000. 12%, but the market is 13, right? In other words, they want more interest than I'm paying. The market wants more money, so we got to give them more money. So here's what happens. How do we do this? Nothing is what you would think is logical. It's not that what's happening here now is we're actually getting less money. Cash in my bank is $96,000. The bonds payable are $100,000, but I'm paying that extra $3,500 to you, so you'll take my bond at 12% instead of 13%. Does that make sense? Okay, I've got to give you more money, and I'm still paying back the $100,000, but you're only giving me $96,000. So you're still going to get your percentage. Your regular percentage, whatever the interest rate is, plus the $35.94, right? That's what I'm paying extra discount. I'm discounting my note from 100 to 96, so you'll buy my bond. Okay, so and then how you pay that back? Here's the counting on that. Let me go back to the next one. Discount. It'll show you. Here's how it goes back when I pay back. The next one is at a premium. Face amount, interest rate on the contract's 12%, but the market is 11. So now what's happened is I got more money. Remember, I just said that I came up with the cure for COVID-19. I shouldn't have to pay that high interest rate. I should get a better rate. And instead of you just saying, well, I'll give you 13% instead of 12, no, the paperwork says 12, and if I go back to the attorney, I'm going to pay them another $100,000 to write up the same paper again. So instead of that, you're going to pay me an extra $37.96 to make up for it. So see, this is how you see. Now that means a premium means I'm getting more money. Even though it says 100,000 on it, I'm getting that extra money. Okay, so that's the easiest way I can tell you. Now okay, so here's the spreadsheet. And this is one that a guy that I use a lot for Excel is great. But here's the deal. If you're doing your homework and you stick the numbers in here that it's telling you, so here they've got it, and they're using $1,000, but it could be 1 million or 10 million or whatever, 1 billion. Doesn't make any difference. For demonstration, you'll see I've got 100,000 and 30-year maturity. I'm going to pay it twice a year. My coupon rate, or the the rate on the contract, I put contract, is 6%. So I'm going to pay, this says a coupon rate divided by N because I'm making 2 payments a year. So it's 3% every 6 months. So my semi-annual payment on my interest is $30. So this is at $1,000, right? Every 6 months I'm paying $30 for a total of $660 for the year. Okay, 6%. It's going to be 5 years, 60 months. And here is the market. So now this is kind of a cool thing because what you have here, if you fill in these, now by the way, remember, if you're going to use the one that's in there, save it to your own computer, but watch what happens. And here's my bond price, my par, what they call the par value. Here's the face value on the documents that we wrote up. These are all on the documents, the 6% and that. But now the market is what changes. Right? So today, let's say the market is down and it's at 5.5, and you'll say it's green because now it's at a premium. See, it says premium. I'm going to get $73 premium because the market is only demanding 5.5, and our bond is paying 6%. So remember on this scenario where I'm getting more money? Right? I'm getting more money. I'm getting $1,073 instead of 1,000 because the market is lower than the contract. Okay, now let's do it the other way. Let's go 7%. And now, because the market demands 7%, it turns red. It says discount, and we got to discount it by $124, our money. And here's how much I get. I only get in my bank account $875 instead of the 1,000. Okay, so I don't know how it's set up in Cengage, but this is one good way you can check your work. You can put the information in here. Now I have it set, if it's 6 and 6, it's yellow. If it goes down, it's green. If it's below 6 in this case. If it's above, it's red. You can change this, I take it. Let's try it. Yeah, see, so I've changed them to 7 and 7, so whatever scenario they're giving you, I could go 6 here, and that's, see, so it's an interactive spreadsheet that will help you.